Every single month, I bring you the best stocks to buy now. Can you believe it's already July? And you're wondering, which stocks should you be buying in this environment? Today, we're going to cover 7 dividend growth stocks that I think are attractive at these levels and lower. This is a rapid fire video. It's going to give you several stock picks, provide a quick overview of each company, some valuation metrics, and some commentary. Without further ado, let's dig in. And as always, I'll be providing a variety of stock picks, a variety of sectors, market caps, and dividend yield. The first stock pick today is going to be Visa. Now, before you fast forward, you're going to want to hear what I have to say about this company. I think many people assume that Visa is just a credit card company, and that's not the case at all. Now, Visa still is the largest U.S. credit card network. And you can see on your screen, Visa really dominates when you look at credit card market share by network purchase volume. Now, these numbers are in billions, and you can see at the bottom of your screen, 2021, Visa really dwarfed the competition. Look at MasterCard, American Express, and Discover by comparison. So Visa is this teal color, the same color as my shirt up here. MasterCard in the purple, American Express in the blue, and Discover way down here in the yellow. This Visa flywheel gives you a great idea of what Visa is all about. So in the middle, you've got the core products, of course, the credit, debit, and prepaid, and that's what most people know Visa for. We can see in the white here, you've got tap to pay, click to pay, you got tokenization. Globally, we have over 30 countries and territories with more than 90% contactless penetration. Tokenization, at the end of fiscal year 2022, Visa provisioned $4.8 billion in network tokens. This actually surpasses the number of physical cards in circulation. And then you got government to consumer, business to small business, business to business for larger businesses, business to consumer, and then P2P. But then they have the value-added services in the outside in the blue. So you've got risk and identity solutions, you've got open banking, advisory services, issuing solutions, acceptance solutions, and so on. And at the bottom, you got foundations. So they have technology, platform, security, brand, and talent. And of course, networks are really the infrastructure that enables money and data movement between endpoints. So here are all Visa's networks. You got Visa Net, B2B Connect, you got Visa Direct Payout Services, and then future network capabilities. And to piggyback on top of that, this is just from yesterday. Visa acquires Brazilian fintech startup Pismo in a $1 billion blockbuster deal. And of course, Visa is almost a $500 billion market cap, so $1 billion doesn't seem like a huge number. But the point here is that they're doing more in fintech. So Pismo is actually a SaaS business, mostly made money by charging transaction fees. Through the acquisition, Visa can better serve a financial institution and fintech clients with more differentiated user solutions they can offer their customers. And you can see the startup has racked up a big name of customers, including one of Brazil's largest banks. The startup processes almost 50 billion API calls and 40 billion transactions volume annually. It powers almost 80 million accounts, over 40 million issued cards. So this is a pretty big deal, especially with Latin America. And as you know, one of the reasons I'm bullish on Mercado Libre is the fintech segment of their business. This could help compete in some of those areas. So this is Pismo's website. You can see card issuing, core banking, digital wallets, digital lending, and seller management. So total volume for Visa, including payments and cash volume. You can see the trend is nice here. 2020, 11.3 trillion, 2021, 13 trillion, and then last year, $14.1 trillion. And that payments volume has gone up significantly as well, from $8.8 trillion in 2020 to 11.6 trillion last year. And a lot of people think that credit cards are going away, but you can see the cards have also trended up as well, 3.5 billion to 4.1 billion. And then net revenues are growing steadily as well. And earnings per share have gone from $49 to $7 since 2022. Unfortunately, this stock is up 2.35% today. I was looking at this yesterday, and I really like this stock closer to like 225. And I think the stock is probably fairly valued where it's at now. It's about a 30p ratio. But if you're looking for a long-term investment, some diversification in your portfolio into financials and fintech, I think Visa could be a good play. Now, the dividend yield's a little smaller on this one. This is going to be the smallest dividend yield that we cover today. It's a 0.8% dividend yield. And it's a mega cap, about $470 billion market cap. Short interest is 1.9%, not that significant. 52-week range. So this was down to 174.60. This happened October 13, 2022. And then April 21st of this year, we saw the high, the 52-week high at 235.57. You can see all the growth metrics here in Fidelity are green. They're positive. It's not a hyper growth stock or anything, but it has nice growth, and I think it's a solid long-term investment. Price to sales ratio for Visa, it's expensive here at 15.17, but we also look at other metrics. For example, the PE right now, based on this year's estimates, 26.5, next year 23.3, much more attractive. Price to book is about a 12.74. That PEG ratio is a 2.08. You like to have that closer to 1, but 2 is not too bad. So for me, Visa, I think it's attractive here. It's not going to give you stellar returns necessarily from the valuation it's at today. If there is a pullback, especially closer to $225 a share, I think it's an opportunity. My preference would be 225 or less DCA. Now, you remember the news on Netflix. Netflix is trying to crack down on sharing your password with family members and friends. Now, Costco is following suit, and Costco is cracking down on sharing membership cards. I don't necessarily think that's a reason to buy the stock, and I'll provide more information here in a second. This is pretty funny. Some shoppers are buying Costco's $4.99 rotisserie chickens and paying at self-checkout. The problem is they aren't members. Oh no. And that's a big deal. If you think of the hot dogs, rotisserie chickens, a lot of people say the loss leaders are not making a lot of money on those items. And so if you have people coming in that aren't buying anything else, this could hurt margins, could hurt the business. Now, Costco had 66 million paid members and 119 million card holders in 2022, making it one of the largest membership clubs in the world. And that's the reason I've owned the stock since 2015 long. Costco members pay either $60 for a regular membership, if you're not aware, or $120 for executive cards. Now, those executive cards give you cash back at the end of the year. My family spends enough money where we actually pay for the membership each year and get some cash back in our pocket. Okay, I made a mistake. I lied to you on accident. I said that the last stock, Visa, was the lowest dividend. This one actually is slightly lower at 7.76% dividend yield. Now, this trades at $531.92 a share today, down slightly, and it's not dirt cheap. This trades at almost a 40 PE ratio. But I actually do like this stock, especially on a pullback, and you can see overall it's pretty resilient. In January, it was $447.90 a share. That's a 52-week low. The 52-week high was on August 18th. That's $564.75. What I like about this company is it's consumer staple, so it's going to perform really well in any kind of environment. If you have a bear market, people probably still buy at Costco. If you have a bull market, the economy is good, people are going to spend even more at Costco. This is a mega cap, $236 billion market cap. And you can see from the growth, the numbers are somewhat mixed here. I think the opportunity for Costco, there's a couple opportunities. One, more international expansion, which I think now that supply chain issues have improved, I think you might see an acceleration in some of those membership clubs internationally being built. You know, materials are less expensive, labor in some countries less expensive, and so on. Another reason I like this stock, and it's not the only reason to buy, is periodically they've been paying special dividends, and I think there's probably going to be one of those coming here soon. And that's simply a hunch. It may not happen. Price to sales ratio on Fidelity, it shows a 1, which, you know, that's not too bad. Of course, this is a lower margin business. The membership fees are recurring for the most part. That's one thing I like about this business. I generally like to buy stocks and companies that have recurring revenues, recurring fees of some sort. And of course, with Costco, you got recurring revenue with membership fees. So I'm not trying to compare it to SAS or anything, but it is one thing to note. I like that part of their business. I do think that Costco has a moat. This is where I buy all of my groceries. And I think the reason I want to include this, if I'm starting out a portfolio, if I'm young, this isn't a bad stock to own for some diversification into consumer staples. And it's never really on sale. So keep that in mind. This stock never really comes down to super attractive PE ratios or anything like that. The PEG ratio is 4.76. Now the PE ratio for next year's estimate is 33.8. Still expensive, but this is really trading historically where it always does. So just to show you what I'm talking about, down on the bottom here, PE ratio, it has gone up steadily over time. But if I look at, say, 2017, it got up to about 29. Here it was a 33.81 in 2019. It was all the way up to almost a 39 here at the end of 2020. In November 2021, this was way overpriced. It was a 45.9 PE ratio. And you can see even in February of this year, when the stock was much lower, it was still a 35 PE ratio. So the people that are waiting for Costco for it to come to a 20 PE ratio, it might not ever happen. It's a high quality business and it carries a premium for it. So check out Costco. I really do prefer this stock under $500. It's probably not going to happen. I think it's probably going to go up to $550 here if the market stays bullish. Now, this next one does have some risks to consider. There's macroeconomic risks, there's pipeline concerns, legislative concerns, and so on. But I wanted to give you a higher yield. Some people watching want a higher dividend. AbbVie fits the bill here at about 4.46% dividend yield. Now, it's trading at about $133.76, and I think it's attractive here. It certainly can go lower. You can see the stock was up to $165 here just in April of 2023. So if you draw a line from where it's trading, right now it's trading at the same levels as it was end of January 2022 and even December of 2021. Now this stock went up because a lot of people went into safety. They went into these value names. They wanted to collect yield while there was a bear market. And so there's always going to be a cycle out of these names as people buy growth stocks and so on. So generally when I buy these type of stocks, I like to buy them against the grain. And again, I think the stock can go lower, but it is attractive 135 or less. My preference for AbbVie would be 125 or less. Now, this company focuses on analog semiconductors, and they're really used in a wide variety of applications. Now, this company has been under pressure because of macro headwinds. And I think for me, if I like this company, I'm dollar cost averaging and I'm building a position because I think there's going to be light at the end of the tunnel. And that could be sooner than you think. Now, some amazing financial performance highlights here. 11% free cash flow annual growth. This is 2004 to 2022. 19 consecutive years of dividend increases. That's a 25% compound annual growth rate over that same period. They reduced their shares since 2004 by 47% through buybacks. And strong with free cash flow, return on invested capital, and so on. This is Texas Instruments. My target for TXN, this was on my watch list for quite a while. It was $150 or less, and it actually got to $144.46. This is July of last year. I didn't pull the trigger, but I am considering starting a position in Texas Instruments soon. It got to 186 here, March 31st, just of this year. It's pulled back. This trades under a 20P ratio. Now, historically, this doesn't have a super high P ratio compared to other companies. It's a large cap, $158 billion. They're doing some great expansions when you think of fabs, especially in Texas. I've covered that on the channel before. And if you haven't seen it, there's a 50-minute deep dive video on the semiconductor industry. And it talks about TXN and semiconductors in general, but specifically that video covers TI's expansion plans. I'll put a card up at the end of this video. If you haven't seen that, definitely check it out. So TXN pays a 2.83% dividend yield. And you can see why the stock's been under pressure. Some mixed results, especially when you think of EPS growth. So TXN, my preference is 165 or less, but I do think it's attractive still, 175 or less if you're thinking 3 to 5 years out, if you're holding as a long-term investment. And I've talked about Tractor Supply several times in the channel, so I'm not going to go into a lot of detail because you can find that in the channel if you're looking for more DD on this company. It's trading right now at about $217 a share, 22.3 P ratio. Now, this is a high-quality company, and it does carry a bit higher premium. Dividend yield is just under 2%. It's about 1.9%. So this got down to $181 September 2022. The 52-week high was April of this year, April 21st at $251.17. And this is a mid-cap, just under $25 billion market cap. You can see in the chart, it's really falling off a cliff here, and it's really forming a base. I think it is attractive here. I'll give you some price targets in a second. This company has solid growth, and I think it'll continue to do well. And like I've explained in the past, it has more of a moat than most brick and mortar retail businesses. A lot of the areas these are located in are more rural, and there's not a lot of options for those citizens in that area to shop elsewhere. Price to sales ratio 1.65, price to book 12.4. That PEG ratio is 2.54. The PE for next year's estimate 18.8. I think this is attractive, $215 or less. If this stock gets below $200 a share, it's a pound the table buy for me, in my opinion. Hopefully you're enjoying the video. Now, I do one of these every single month, and this video is focused on dividend growth stocks. On Saturday, we're going to be doing the same thing, but for growth stocks. So the best 7 growth stocks to buy now. I scan hundreds of stocks that I follow, and every month I try to bring these videos to you to show you stocks that I would be buying at specific levels. And if you're new here, make sure you subscribe, click that bell for notifications, and drop a like and a comment if this video is helpful. I appreciate you. And before we go on to the next stock pick, I need to announce this video is sponsored by the Motley Fool. If you'd like to see the 10 best stocks to buy now, visit fool.com/firedupwealth. A reminder, Fool doesn't tell me what stocks to cover, what to tell you guys. They're a great partner, and check those guys out. I also encourage you to join our private community, Patreon Discord, the best investing Discord on the planet, by visiting patreon.com/firedupwealth. Let's add some more diversification to this list with a defense stock. I don't think a lot of people understand how diverse and complex Lockheed Martin's business is. I mean, they cover everything from autonomy and AI, cyber, maritime systems, space, sustainment, transformative technology, and more. Now, I'm not saying that you go buy this stock because it's involved with AI. I'm not going to hype it like that or anything, but I think it is cool just to see all the different areas they're working in. Okay, Lockheed Martin, it's $454 a share. The PE ratio, 20.54. Dividends about 2.67%. Large cap, $115 billion market cap. Now, the 52-week range, the low was last year in July. It got down to $373. The high was April of this year. It got to $508. And I think it's probably going to head back to $500 if the market stays bullish with some time. Now, it's important to note that this is not a growth stock, and you're probably owning it really for dividend and the growth growth of that dividend, but it does give you some nice diversification into the defense sector and even in space exploration, all while paying over 2.5% dividend to boot. Price to sales ratio on Lockheed Martin is 1.76. If you look at PE for next year's estimates, about 16.4. My preference on this stock is $435 or less, and that might not happen. I do think it's attractive at $450 or less per share as a long-term investment. Now, rail companies are responsible for 43% of all intercity freight transportation in the US. And if you look at the data, it's becoming more cost-effective to use railroads versus semi-trucks. The expenses for logistics have gone up significantly since the pandemic, and you're paying those drivers a lot more, and it's harder to find those drivers. Now, this is a very cyclical business, and so if you go into recession, this stock is going to get crushed. If you think we're going into a bull market, a multi-year bull market, and the consumer's going to be strong, this stock is going to rally, but it's a cycle. And if you look at like Peter Lynch, you're generally riding cyclicals. You're trying to buy them at the right time. You ride them up and you sell them. So these are not buy and hold opportunities forever. They might be 2 or 3 year holds. Now, what's interesting about railroads in North America, if you're not familiar, they operate really as duopolies. So when you think of the western part of the United States, you really have UNP, Union Pacific, and then Berkshire Hathaway's Northern Santa Fe. On the east, it's controlled by NSC and CSX. And in the north, you've got Canadian Pacific and you got CNI. So if you look at this zoomed out chart, this max chart, you can see the Great Recession right here, where it dipped down significantly. You can see another dip here, 2016. And you can see they're always sharp moves, then they climb. This dipped really hard here in the pandemic. It dropped all the way down to $103 a share. And in April of 2022, this got up to $275 and fell off a cliff down to $200 a share. So it pays a 2.5% dividend yield, 17.96 P ratio. But really, if you're buying this, remember it's highly cyclical. I prefer it $200 or less DCA. And again, you're not going to hold this for 5 or 10 years. You're probably just going to ride a wave of 2 or 3 years for some profits. If you're new to the channel, make sure you subscribe. I got another video coming in 2 days for best growth stocks to buy. Make sure you hit the like button. Drop me a comment. Thanks for watching. Have a great rest of your day. Take care.